Hello and welcome viewers, this is Malika Mishra on NDTV Profit and you're watching Your Money Matters. Today, we're diving into two very interesting subjects. While mutual funds are excellent for systematic income, there's another asset class that has been quietly delivering strong, regular payouts without you buying a single flat or shop. Let's talk about REITs, Real Estate Investment Trusts. REITs, the hottest conversation in personal finance right now. We'll cover what exactly are REITs, why did they beat both equities and government bonds throughout 2025. The 5 listed REITs just distributed a massive 2,450 crore to over 3.8 lakh unit holders in 1 quarter alone. So that's a massive sum of money. Who should invest? What should your 2026 portfolio allocation look like in the context of REITs? And the game-changing RBI decision, what it means for dividends, regular income, potential, and a lot more. So to answer these questions, I have with me Shirish Godbole, CEO at Knowledge Realty Trust. Thank you so much, Shirish, for joining us.
Thank you, Malika.
My first question is quite basic. In simple terms, what are REITs and who should be investing in them? And would you advise young investors to get into REITs?
Thank you. Thank you for having me. And there seems to be a lot of questions, so we'll try and answer as quickly and as succinctly as possible. But I think, and you alluded to mutual funds to start with as well, I think the best way to explain what a REIT is the fact that it's a mutual fund. It's like a mutual fund. You know, a mutual fund has a lot of holdings. And then on the other side, it has a lot of unit holders who hold units in the mutual fund. And a REIT is exactly similar. So a REIT is a trust, a real estate investment trust, but really likened to a mutual fund, which below it has a bunch of physical assets that it owns. And then on the other side, it issues units. So anyone who literally can buy one unit and own a piece of the real estate, but doesn't obviously have to buy the whole real estate, just buys that one piece of paper, right? And it could be, I mean, our shares trade today at 126 rupees. Let's say you could buy a share at 126 rupees, or you could buy, obviously, 1 lakh shares at that same price. But it really, and this is what it was conceived for, is the common man can own a piece of real estate, which otherwise would have required lakhs, crores of rupees to buy, and a common man could not have bought, right? And that's what the REIT really drives home, which I think is a great opportunity for a common man to own real estate.
Right.
And sorry, your other question was about... Do
you think young investors should get into REITs, and how do you compare these with regular mutual funds?
Yeah. So, I mean, it's a lot of, I think, to answer that question. Should one buy a real estate investment trust? The answer is absolutely yes. Okay. And I think it may cover many of your other questions, so give me 2 minutes to answer.
Sure.
Because a real estate investment trust gives you both a stable yield and the opportunity for growth. And you know, very few products in sort of the finance space offer you both, right? There are fixed income products which give you a yield, and there's equity instruments, equity stock, which gives you growth opportunities. This one is a combination of the two, because what we have is a number of assets, right, which we own, and that distributes a yield which we pass on to the unit holders, typically about 6% plus or minus, and that's a pretty efficient tax model in which it's distributed. So really, you have to compare it on a pre-tax basis with fixed income products. So our pre-tax yield could be comparable to almost 8%, let's say. And so post-tax, it comes down to 5.66, which is what we distribute. So it's very attractive from a yields perspective.
So
and at the same time, it gives you growth because the value of our assets increases. We have rental appreciation built into our leases, plus the value appreciates, and that growth comes in as well. So when you combine the two, it is a great stability and yet growth.
So what's the average range of returns that REITs offer?
So we typically give anywhere between a 5 to 6% effectively post-tax yield that's distributed on a quarterly basis, right? And on top of that, our rents appreciate 5% per year at a minimum. They could go higher. And so therefore, you get a little bit of stability, like I said here, plus that growth. So together, a 12 to 15% return annually for a REIT is a very decent assumption to make.
Okay. I have a very fundamental question to understand how REITs work. You did explain the the return aspect of it. But for example, if there is a real estate investment trust that's handling a couple of properties, how does that distribution work, and how exactly does the money finally flow into an investor's account in terms of returns? Could you give an example with, for example, a REIT handling, say, an office and a mall?
Yeah.
So how
So
would that work?
I think in both cases they're quite similar. So you have a physical asset. In our case, KRT, we have a number of offices, right? We have one BKC right here in BKC. We have a lot of tenants who occupy that space. So what the tenants do is they pay us a rent on a monthly, quarterly basis, right? We collect that rent, we pay expenses to manage the premises, and there is a net operating income left after, you know, all of those expenses, the tax and other things that we have to take care of, and so you end up with a distributable cash flow that's available. The way regulations have been set up, two things about REITs which are very important to note. One, at least 80% of our assets have to be physically, fully completed, built, leased assets, right?
Yeah.
So it's very different from a real estate company, which is in the business of owning land, developing land, etc. We are primarily in the business of operating assets. So most of our assets are yielding, they're tenanted, we have income that's coming. And number two rule of a REIT is most of what we have as cash flow has to be distributed.
90%?
So literally 90% of it, at least, right? In our case, we are distributing all of it, but at least 90% of it. So now we have collected this rent, this cash flow is left over, and then that has to be distributed out. And so literally we make payments to all our unit holders, depending on whether you have 1 unit, 100 units, lakh units, etc. We calculate that, and it's a tedious job actually, and we actually make the payments out, and there's nothing left, and the next quarter it starts over again, and the next quarter it starts over again. So it's very simple, it's very, I think, very transparent and very clean. And one of the reasons REITs have been more and more accepted is, you know, it is now very well governed. You know, there are very professional management teams in place. It's a very institutionalized, transparent product, which is what has led to people believing in it more and more.
Okay. And I think another move, and I would like to get your opinion on RBI easing regulations on REITs as well, in the most recent regulation that came in, where now REITs can borrow money from commercial banks as well, which was not the case before. Now that makes borrowing costs cheaper. And for example, it would also increase the dividend payout that ultimately goes to the unit holder. What is your opinion on the acceptance of REIT today and in the decade to come? And as we were just having a conversation before this interview started, what do you think, what kind of assets would be most promoted under REITs?
So first of all, regulatory support. We have had tremendous regulatory support. And it's not just the RBI, but the SEBI has also been very supportive of getting this product out in the market. As I was mentioning earlier, it is the easiest way for a common man to own a piece of real estate. So commendable effort by both. This latest move by RBI really is a financial move, which helps us because it, like you said, reduces the cost. It has more people that can offer us debt, right? Now, the reality though is REITs as a product have very low LTVs, very low loan to values. So while it is a good move and definitely helpful, it is not going to dramatically change what we do because, you know, we are set up to own assets. We have the assets we have low gearing, low financing. Yes, we can lower our rates a little bit more, which will allow us to have slightly higher distributions. And to us, you know, like I said, there are two real cornerstones of any REIT, which is distributions and then rental appreciation, right? Because that's how we get our growth. And today, what this does is it allows us to get our yields slightly further up because the financing becomes a little bit cheaper. That allows us to get the yields up, which should help distributions, which should help unit holders ultimately. So that's the current move. But SEBI has also been very, very good. The other move that happened last year is making a REIT equity product. What that classification has done, and this was SEBI coming to do this, was very, very powerful because now all equity mutual funds will look at REITs as an option that wasn't available before.
What does that change?
Before, we were considered to be more of a fixed income instrument, and so we had the status where mutual funds who had a hybrid status or mutual funds who had a fixed income focus could invest with us, right? And so there are a lot of funds do have hybrid sort of funds within Kotak or ICICI, etc. So they could invest with us before, but the so-called equity-only mutual funds could not technically invest in a REIT. Okay. Now what that does is now any fund effectively can invest, right? And so clearly the number of potential investors has gone up. We are seeing a lot of interviews, meetings with mutual funds interested in buying REIT product. That will help further distribution. That will help further growth of the product. So regulatory support for our product has been very good, and we are very thankful, for it.
We've spoken about the various advantages of REITs and how it ticks many boxes. But I think it is also important to understand a disclaimer that REITs comes with. What kind of risks should one consider before investing in REITs?
Yeah. Before I answer your question, I'm sorry, I'm going to answer a different question, which is actually why should a common man own REIT versus owning physical real estate? And then I'll come to your disclaimer.
Okay.
Because that is a very important question, right? So if you step back in India, people love to own real estate. And I mean, the just getting in and out is so hard.
Yeah.
The amount of money you need typically, I mean, the smallest thing is now 1 crore to buy. I mean, how many people are walking around with the ability to just shell out 1 crore to buy real estate, even if it's residential, right? Then even if you own an asset, you have to lease it out to someone, if it's an investment, and you have to manage it. There are repairs, maintenance, costs. And after all that, the yield you get is not something great, right? I mean, in a residential, it's pretty low, 3-4%. In an office format, yeah, you might get 7%, but then there are all these costs that eat into it. So when you look at that net result of the whole experience, the friction cost of getting in, getting out, illiquidity of the product, why would you not simply just buy a REIT share, which gives you a 6 to 7% kind of yield, or maybe 8 on a sort of a pre-tax basis when you look at it. You don't have any of the management issues. You get in and out easily. It's very liquid. You can go and sell it tomorrow. Therefore, I think the common man should really look at this. And as far as issues to watch out for, I mean, honestly, again, there's a bit of a sort of anecdote again, but we look at ourselves. I look at KRT, Knowledge Realty Trust. We have a 55,000 crore market cap. We are like a luxury liner cruise ship. I mean, seriously, think about the ocean, and you're either a cruise ship out there. It's going to take a lot to topple the cruise ship, right? There will be small issues here and there, but the size of the portfolio, the diversity of the portfolio just allows you to be, sailing through troubled waters pretty easily. So in terms of risks, I mean, of course, there could be a COVID again. The world of office demand could change dramatically at some point of time. But today, there is tremendous support both for India's growth and, GDP, as you know, is growing up further. So therefore, there's tremendous growth for office demand internally. And you've got this whole GCC story, which is the Global Capability Center story, which continues to support offices going forward. So when you look at that, at least in the short run, we really don't expect any risk factors that are significant.
Okay.
But in the long run, very high interest rates, COVID-like phenomena, big change in the way people consume real estate, whether it's residential, whether it's office, obviously could have an effect on us. But in the short run, I feel very excited and very comfortable with what we have.
Understood. Thanks so much. It felt like a crash course in REITs done in 15 minutes or so. Thanks so much. It was a pleasure having you, Shirish Godbole. And viewers, so in 2026, REITs have become a serious regular income contender thanks to strong 2025 performance and the RBI's recent moves that are likely to support higher dividends as well. And it's not just the RBI, but as Mr. Godbole highlighted, it's the SEBI as well that has supported this form of investment. They suit investors who want real estate exposure with liquidity and quarterly payouts.